All right, so we've had another federal budget handed down, and this is technically the second one for this Labor government, having done a sort of mini budget late last year. But whilst the last budget was shrouded in a lot of terms around uncertainty and a lot of the challenges the government was facing, the reality is none of that's really changed too much. Yet we've seen a pretty major change in the expected receipts. So particularly because of some very strong commodity prices, the government's ended up with a fair bit more money than they thought. And so the question is, what effect, if any, of that has had on the budget. So look, the super short version for those who are interested in spending the least amount of time possible on this thing, there really isn't much in this budget for us to worry about from a strategic sort of positioning perspective. So if you're not really interested in detail, won't be offended if you turn off now and go and find something else better to do. But for those of you who want to, we'll go through a little bit of detail, and then I've got a couple of questions that people have been asking me in recent times, knowing that we would be doing a budget update, to delve into a bit more detail about some thinking around things. So, all right, so let's get into a little bit of detail. Probably the main thing in this budget that might affect a few people is the previous announcement around the $3 million threshold for superannuation accounts. So the short version of this is just extending the, or bringing in a limit, if you like, where additional tax is payable on the earnings within super funds. So at the moment, as we know, in the super fund, in the accumulation phase of superannuation, the earnings are taxed at 15%. And when we move into pension phase, the assets supporting a pension, what we call exempt pension assets, are exempt from tax. So not only are the earnings themselves within the fund exempt from tax, but also then when the member, if they're over age 60, takes them out, they're exempt as well. So there's no tax at all. Now, what this proposal was announced, I think back in February initially, saying that the government was looking at, for balances, individual balances, so this is an individual measure per person, have a balance of greater than $3 million, then that tax rate of 15% would increase to 30%. Now, we did a little bit of, I think we did a couple of videos on this sort of at the time, and there was a paper the government released, a consultation paper, which doesn't seem to have made any difference to anything. So not really sure what the consultation process really was there, because this seems to be pretty much what they originally announced as the proposal. So who will this affect? Well, obviously, some of you will have account balances over $3 million. Some of you won't necessarily have that individually, but will have it collectively, say part of a couple, a combined balance of over $3 million. I guess the concern with this potentially is the fact that while many of you will think, well, that's be a nice problem to have, and we're well below that sort of threshold, the intention is not, certainly at this stage anyway, is not to index that level. So $3 million is a sort of number, particularly with relatively high inflation earning rates and accumulations. It's a number that could be reached much quicker than people potentially realise. So even if you've got a relatively low balance of, let's say a bit over $1 million, $1.5 million, it can be under, certain circumstances, getting to $3 million can be achieved in a lot shorter time than we think. But realistically, for most people, it's not going to be an issue, because they're going to be either, well below that, and/or there's plenty of things we can do to kind of spread that load. So keep in mind, this is in addition to the $1.7, soon to be $1.9 million pension transfer balance cap, right, which is a maximum you can put into the pension phase as well. That's looking at your sort of total balance in super and the tax on that accumulation phase. So if you had, let's say, from 1 July, when it's 1.9, you had $3 million, your 1.9 could transfer into the pension phase and would be tax-free on that earnings. But the other 1.1 would be taxed at 15%, and anything over that $3 million then is going to be taxed at 30%. So that's the kind of implications on a per account balance basis, and therefore things like balancing up superannuation accounts, particularly between couples, will continue to be a fairly important strategy. The other relatively minor tweak in some respects is the idea of moving to what they call a payday superannuation contribution. So at the moment, a lot of people may not be aware of the fact that superannuation contributions by employers only have to be paid quarterly. So while your payslip might say, you got paid, $1,000 this week, and you got, a super contribution allocated to that, similar to the tax that you paid. It's really tax paid by your employer. That tax isn't paid every fortnight or week or month whenever you get your pay. It's paid as part of their tax instalment program that your employer's on. And superannuation's been part of that regime, if you like, in the sense that it's only been paid quarterly, and it normally had to be paid within 28 days of the month following the end of a quarter. What the government's proposing here is to make employers make those contributions as they're paid. So if you're paid weekly, your superannuation contributions will be made to your fund weekly. Good or bad? In theory, it's probably a better thing in the sense that, essentially by making superannuation contributions into generally largely growth, if not fully growth assets in your superannuation fund, then you're going to be dollar cost averaging on a more frequent basis, which in theory is a better idea. Helps to smooth out that sort of entry volatility, provided, of course, it doesn't put a undue administrative burden onto the employers who are doing this in the first place. So the super stream system, which has been in place for a while now, in theory should make this relatively seamless, but like all technology, it's great when it works and a bit problematic when it doesn't. I think the theory behind this, or the rhetoric behind this, has been the idea that there are cases where employers don't pay superannuation contributions because by the time it comes around to paying it, cash flow, other business issues means that the business isn't able to, and people kind of miss out on their super. Whereas if it's paid more frequently, I guess in theory the employee just goes broke a bit quicker. But anyway, that's a part of the rhetoric around why it's a good idea. So yes, all things considered, from an administrative point of view, if it's not too big a burden on small businesses, because that's who will obviously have the biggest issue with this, then it's probably not a bad idea. There are a few other measures around, addressing housing affordability, with due consideration around, the way to address affordability is to throw more money at something is always obviously a little bit of an interesting thing to get around. But there is some strategy options here, opening up a bit of sort of first home buyers and some of the schemes around, providing guarantees for people buying their first home. So, if you've got anyone, children, grandchildren who are going through that situation and moving into the sort of first home scenario, there's certainly some strategies there that are increasingly open up in terms of opportunities. So, so that's certainly something to look at. Most of the other issues with the budget were, pretty minor or targeted more towards sort of low income. The sort of middle income, middle wealth part of the market really didn't see a lot out of this budget particularly, which is probably not too surprising given that it's a Labor government budget. But I guess the other thing, from an overall perspective, it is quite refreshing, if not very glad to see that this particular government has refrained from sort of dipping too heavy into the cookie jar, especially considering that the revenues have been a lot stronger than was predicted even a few months ago. So we had a small surplus. It's the first time in I think 15 years they're sort of saying we've had a surplus, and the first Labor government to do one since Paul Keating, which is interesting because it wasn't really this government that created this surplus. Most of this spending and revenue were the result of things that were already in place. So budgets, the next budget and the one after might have a little bit more to do with this particular government, but they really haven't had their feet on the desk long enough to be claiming too much of the good or bad in terms of how this budget's come out of balance. So, but it is good to see them taking a pretty conservative approach going forward. Probably the real good news for most people is the fact that there was a bit of an extension to Medicare levy thresholds, but otherwise no other changes to the tax rates. There was a little bit of talk a while ago around the stage 3 tax cuts, which have already been legislated, being sort of repealed or pulled back. That sort of hasn't happened as well. There's been a little bit of money thrown around reducing energy bills and healthcare costs, etc., particularly trying to drive up some bulk billing for medical, and some income support payments for students and sort of working age people, and also some expansion to parenting payment and some of the renters and some of those sorts of assistance. So as I said, really targeted towards lower income people. marketed around this sort of idea of trying to deal with the cost of living sort of scenario. So will it really do that? I guess the short answer is it probably is a good budget in the sense that the more government spending, then the more inflation we're likely to have, and inflation is likely to continue to be high. So, it's good to see that they've certainly held back on that a little bit. What does it mean for share markets in the economy? Well, I guess the good news is share markets don't really care too much about budgets, other than maybe a bit of trading in and around the day or before and or after the budget. But markets are much more forward-looking than what the government's sort of proposing to do from a policy point of view. Again, keeping in mind that these are still policies, even though they're announced in the budget, they still have to be legislated, and they still have to pass both houses of parliament and then receive royal assent. So, doesn't seem like too many of these things won't get up. I would say would be my initial reaction. So, but we'll see. There's always a bit of horse trading when it comes to some of these sorts of policies being not good enough or targeted to the wrong interest groups or whatever. So, but all in all, a pretty decent budget, and one that I'd say we'd actually give a surprisingly good rating to, considering what we potentially feared. So that's it for the budget summary. As I promised, there is a couple of questions people had been asking in the lead up to the budget in particular. So I'll go into that in a bit of detail now. But for those of you just interested in the actual budget detail, have a look at the attachment that's come out with this email, a few highlights in there. But as I said, from a strategy and repositioning, economic, investment portfolio perspective, we don't see any changes as a result of this budget per se. Okay, so a couple of key questions I've been asked quite a few times, in recent times, and the two main ones are to go into a little bit of detail, not necessarily specifically what we think about the budget, what's the detail and do we think that this or that's a good idea, but actually how do we tend to think about budgets? What's the thinking that goes behind our reaction to things, what we think is a good or bad, and whether particular government policies are going to have a positive or negative impact in terms of A, people's lives, and B, their sort of economic wealth, say, over the medium to long term. And sort of tied up with that to some degree is this sort of concept that all governments seem to be a little bit obsessed with, is around this idea of how good an economic manager they are, and is one party a better economic manager than the other, and has that changed over time, and all those sorts of things. So we just want to delve into those in a little bit of detail, because we've been getting a few questions about it. So I guess when it comes to approach, the way we like to look at things is try to understand, well, what are the fundamental things we need to know to be able to make effective decisions or effective analysis of a particular in a particular context. So we always like to sort of keep in mind when we're dealing with a particular area of inquiry is to say, okay, well, what are the objective truths? What can we measure and we know that's true? And whether it's the revenue being collected or being spent or whatever, versus what we call a subjective truth. So subjective truths are those things that often they can be measured as well, but how true they are is more dependent on particular trade-offs. What do we value? So a good budget, well, we can sit down and look at the data of the budget, saying how much money came in, money came out, and how that was allocated. But if it's a good or bad budget is really much more a subjective truth as well. And one of the problems with subjective truths is that we can tend to be caught more along a sort of ideological thinking as opposed to a more objective sort of thinking. So one of the things that's really important, and we try to be really mindful of, is to say, okay, well, when it comes to a particular subjective truth, what does the data say around whether that truth is more likely to be true? And a really good example of this is government spending in a particular area, because governments will often say, hey, we're going to put all this money towards spending a particular thing, and I'm going to use housing as an example of this in a moment, and to say, okay, well, we think this needs to be addressed, and therefore we're going to make a policy objective and we're going to spend more money in that area. And then what does the data say over time as to how effective that is? Because sometimes a policy can seem like a great idea at the time, and it can even seem logical in terms of how it should play out and work, but we still need to go back and look at the actual objective truth, i.e. the data, and say, well, if we were attacking, say, something like housing affordability, well, has housing got more affordable? Because if it hasn't, well, then the policy probably doesn't work, right? So that's something we're very mindful of in trying to decide whether something's a good or bad idea. And then again, a couple of key principles. We always like to look at what principles underpin, again, in a particular context. And so probably the first and foremost is when we're talking about a budget, we're really talking about allocation of resources, right? So, but it's really important to remind ourselves always that there really isn't any such thing as a resource. In essence, there's really only human productivity, right? A resource is only something that's developed to become useful because a bunch of people have got together and turned it into something. And either it's something as simple as oil or copper or some sort of what we typically call a resource or commodity. Copper's only useful because a bunch of people have got together, got it out of the ground and turned it into a useful version of that particular resource. Okay, so there's not really any such thing as a resource. There's only human productivity that has created the things we might refer to as a resource, right? And the other really important thing to understand is that there is no solution, there's only a trade-off change, right? So a lot of time people will look at saying, here's a particular problem we need to solve, and therefore what we need to do is we need to implement this solution. And in reality, all that does is change what the balance of other trade-offs are. So without looking at those other trade-offs, you can't really sort of say, whether that was a solution overall and did make anything better, because fixing a problem to the degree that you fix that problem, all it does is create more problems. And then the final thing we like to keep in mind is also trying to make sure that we don't expect the wrong thing from the wrong institution. A lot of the time, because we want a particular outcome, we can tend to expect different institutions to provide answers that in reality they're not geared towards. And the way we kind of look at that is that the three main institutions that we look at are markets, science, and philosophy or ethics, or what we collectively believe is valuable, shall we say. And people will often criticise the market because of what they perceive the market does or doesn't do. And in reality, a market's job is to do things in the most efficient and effective manner. Okay, so if you ask the market to do that job, there's no other institution that's better at doing that. That's, whatever you think about markets, that's really fundamentally undeniable. Where people often have a problem with markets is they don't like what the market produces because they tend to value different things. But if the market has produced that thing, it's because it was asked to do it by the collective or by the dominant participants in the market. And so there'll be plenty of people who prefer the market did something else, but in reality the market is just the weight of our combined value. So similarly, when we look at the domain of science, science just simply tells us what's possible, right? And often we can make the mistake of looking towards science and say, oh, well, science should tell us what to do. And in reality, that's not its job. Science's job isn't to tell us what to do. And it's not science's job to tell us the best way to do something. Again, that's what the market does. Science is really there to tell us what's possible, okay? And so looking to science to do anything other than tell us what's possible is, not going to lead to better results, because that's not the job of science. So science tells us what's possible, the market tells us the best way to then achieve that. But it's really our sense of philosophy, our sense of ethics, our sense of values that is the most important thing, because that's going to determine how we direct, or what we should do. So the science will tell us what's possible, but it won't tell us whether we should do it or not. And so that's really where where those institutions come into play. And I think where we can get a bit lost at times is where we don't recognise those separation of powers, if you like, or the separation of responsibility in those institutions, and we start to ask, an institution to step outside its lane. And a lot of mistakes we see people make, and certainly we've been guilty of in the past, is to not apply those lanes appropriately. So I think, all that kind of leads me to the idea of sort of saying, okay, well, whenever we want to look at something, in this case we're looking at, say, a federal budget, a government response to something, we need to be really careful about, at the end of the day, what we're after here is we've got a bunch of resources and we need to reallocate those. And the questions are, what institutions are best placed to do that? Okay, so at the end of the day, we only have human productivity to call on. And then some of those things we can sort out amongst ourselves pretty well, and some of those things we either can't do very effectively or we can't do very sustainably, right? So we need some other institutions to kind of get in the way, and that's really the role of government. So, so when it comes to a budget, depending on how far on that spectrum you stand about how much government should do for us and how much we should do for ourselves, is really going to be the major driver of whether we think, budgets are, sort of good or bad. Generally speaking, where budgets don't take too much from people and spread it out to other people, but leave the responsibility in the hands of most of us, we tend to think that those budgets are the best kind, because they don't tend to create too many other problems further down the track. And it also means that people are more free to be able to utilise their own resources and their own productivity in the way they best see fit. And certainly in our experience, most people tend to be much better at spending their money than other people are on their behalf. So as a general rule, we think that's what creates the best budgets. So, so again, I want to use housing affordability as a good example. This applies pretty much to all governments, all parties. In fact, it's relatively universal around the world. So we often hear about housing affordability, and one of the things I guess that's seems to be sort of forgotten in this entire debate is the fact that there's a few relatively straightforward fundamental economic truths that we can show to be very objective, and that is, first and foremost, is that when you increase the demand for something, you're going to increase the supply, and when you increase the price, and when you increase the supply of something, you're going to reduce the price. And generally speaking, despite what a lot of people seem to often think, the role of markets is generally to make things cheaper. If we look at the most successful organisations, successful businesses of all time, they are the sorts of businesses that made things cheaper and therefore more accessible to more people, and therefore grew their market, and as a result of that have become substantially more profitable. Whether you look at Walmart or Amazon or McDonald's, FedEx, there's a litany of examples of the better companies become at reducing prices, the more money they tend to make, which seems to be a bit counterintuitive in some respects, because you would think if the bigger the margin, the more money a company can make, but the problem with higher prices is you narrow your market. So the most successful companies are the ones that actually drive down the cost. So again, why markets are most productive tends to be because competition tends to drive down the cost of production, and therefore drive down costs and make things more accessible to everybody. So housing is a really good example of where that hasn't happened, and it consistently doesn't happen for a whole host of reasons. But the only real solution to housing affordability is more supply, and that means more land. It means more land available for housing, or it means more land vertically, because you can put more housing on that scenario. So why isn't housing as affordable as it could be? Well, the short answer is because too many policies restrict the reduction in the price of houses. And part of the reason for that, I think, is because it can seem a lot more beneficial, at least in the short term, to all of us, for the price or the value of our houses to go up, because it creates a thing we call the wealth effect. It makes us feel like we have more wealth because, this asset of ours is going up in price. But if we look at it from a pure sort of Maslow's hierarchy of needs scenario, once we have shelter, increasing the price of that shelter doesn't add any more to productivity. So yes, it might make us a little bit more productive because it's a nicer environment, etc. But the more it costs us to house ourselves and to provide our shelter, the less of our productivity we have for other things. So the price of houses going up is actually, I would argue, never a good thing economically. Doesn't mean that it can't be leveraged in some other ways and you can get some benefits from doing so, but as a general economic rule, putting more resources towards your shelter is unproductive and therefore not a great use of resources. So policies that increase the price of houses in that sense are always going to be bad. And any policy, regardless of how well it's targeted or how socially it might be palatable, anything that increases the supply of money to a particular thing, in this case housing, is going to increase its price disproportionately. And even though it might be targeted towards younger people or lower income or whatever the social dictum might be, the reality is the more money you put towards housing, the higher the prices are going to be. Even if you can artificially lower some of the prices today in some way, you throw more money at the same thing, then the prices go up. It's just a fundamental law of economics of supply and demand. The only way to bring it down is to increase supply. Why is that not done more often? Well, politically it's not very feasible, because you can imagine if I was to stand for federal parliament saying, hey, my major policy platform is to halve the value of your house. Well, there's a lot of homeowners who are not going to vote for me. So what seems like it can be in our self-interest certainly in the short term, despite the fact that it's detrimental to us in the long term, is normally not very politically expedient. And the real reason for that is because what we call a law of proportionality is that it's much easier to cater towards a small group of people who will have a very large impact and therefore be very vocal, because everyone who pays for that are essentially dilute and disperse. So the value of my house going up in my inner city suburb means that I feel like I'm getting wealthy as a result. What that means is a whole lot of people are priced out of that market. They can't come and live where I live. They have to now travel, spend more money on time and fuel and other expenses to make up for the fact that they can't live close to where they want to work and play. They have to move further out of town and have lower priced housing further and further away, and spend more of their resources on other things that are in reality related to their housing. They're just now time in the car and time away from family, etc. And so because they're all now diverse and they're not concentrated in a particular electorate, as an elected representative, I'm never going to be penalised by not getting their votes. And so that's one of the downsides to the political system, is that it can concentrate the self-interest of a relatively small minority at the expense of kind of everybody. And as a result of that, we're actually all kind of a bit worse off. So what do we do about it? The way the system works at the moment, probably not a lot you can do about it, other than just recognise the fact that sometimes what's in our best interest in the long term is very different to what's in our interest in the short term, and try and make our policy decisions a little bit more commensurate with lowering the cost of things that are more important to us, and that housing and energy are probably the two main ones. Anyway, so I just want to go through a little bit of that. As I said, I had a few people in particular want me to talk about the thinking behind some of these things, particularly some of the principles and some of the processes we use to try and come up with views, and particularly separating those things of what is truly an objective truth versus a subjective truth, and applying some of those frameworks like, as I talked about, markets and science and philosophy, to try and sort of separate what might seem like a good decision for me may not be a good decision for someone else, simply because in reality the only difference is what we're valuing. And it might simply be that I'm valuing the short term and you're valuing the long term, or it might be that we have fundamental value differences, and it's the realm of politics and our ethics and our collective values to sort of sort that stuff out. And so we kind of have to give a little bit of discount to that also when we're looking at things like a federal budget and say, hey, look, at the end of the day, I'd rather have all of my resources and do my own thing, and everyone else can look after themselves. The reality is, society still has to move at the speed of our at least average slowest, and so we need to keep that balance in place so that those people remain productive, because at the end of the day they're still contributing to the whole. So for the 2 or 3 of you who are still with me, thanks very much for persevering, and as always, if you've got any questions, let us know. Really enjoy going into a bit more detail for those people interested. And if there's any other changes as these policies get implemented, we'll let you know. But for now, it's another budget update, and we'll see you soon, but on a different and more exciting topic, hopefully.